Today I would like to analyze Birkenstock. They are known for the sandals and are very popular nowadays. So they just announced the earnings and the stock price dropped around 20% for the 1 week. So we have the big drop here. And the earnings were not so great because they expected more, but they're still up over 22% from the last earnings. So that's good. But the expectation was 57 cents and they reported 55 cents. So it's a miss, but it's not such a big miss actually. And I don't think the earnings are that bad, but I think they just expected more. And that's why we see this stock price drop of 20%. So the first thing we can recognize is the market cap of 9.45 billion US dollar. So I calculated this market cap with the shares outstanding we can see here and the stock price because the market cap is not accurate right now. So we can see it's still a small company. It can mean it has more room to grow in the future. We can also see they have no dividend yet. So maybe in the future they will have a dividend. Now we can take a look at the financial foundation, and the first thing we are looking for is revenue growth over the last 5 years. We can see here we only have 3 years, so we're going to look at this, and we can also see we have a revenue increase of 16% and in the next year of 18%. So this is a very good number and it's a check here. Now we're going to take a look at the free cash flow growth. So we would like to see them grow over the last 5 years. This is a very important number because the free cash flow can be used to buy back their own shares or to pay the dividend. So we can see here in 2021 it was around 100 million, and now in 2023 it's around 156 million, and in 2022 it was even worse with 103 million. So we can see it's actually decreased. So it's not a check here and we don't really like to see that. Now we are looking for a free cash flow yield over 4%. So this is also important because it can tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. So we're going to take the free cash flow of 2023 and then we're going to divide it with the market cap. So we're going to get the free cash flow yield. So we're going to divide it here with the market cap, and the number we get is 0.01650. So it means around 1.65% free cash flow yield, which is not very high and it's under 4%. So we don't really like to see that. It could mean the company is overvalued. So obviously this is still a young company which is still growing, but still we have the free cash flow decline and the free cash flow yield is not very high as well. So it's not a check here. The next thing we are looking for is debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. So what we're going to do is we're going to take the short-term debt here and then we're going to add the long-term debt as well. Here it's over 2 billion. And then we're going to divide it with the free cash flow that we already had. So the number we get is 13.25. So it means in over 13 years we can pay back the debt with our free cash flow. So it's not a great number. We don't really like to see that. It's not a check here. So we can also take a look at the cash on hand. So how much money they got in the bank. And we can see here in 2023 it was around 364 million. So it's not a bad number, but compared to the debt of 2 billion, it's not very high as well. So the last thing we are looking for is shares outstanding decrease. So this means the company buys back their own shares. So especially for this young company, we don't really expect that they buy back their own shares. So we also can see here they didn't really buy back their own shares. It's nothing really changed. It decreased and then increased again. So it's not a check here, but it's not really a problem because this young company is still want to grow in the future, so they should not buy back their own shares. I would like to give my conclusion about this company. So let's start with the good things. They have a strong brand, so they are known and popular. They also have the revenue growth, which we really like to see. The negative would be the low free cash flow yield. It's only 1.65%, which is not very high. Of course, it's a young company, but we still would like to see this number higher. And this already indicates a high valuation of this company. They also have a lot of debt, over $2 billion. And they rely on one segment. So they rely on selling the sandals, and they don't have so many other products. So I think it's very difficult to invest in this company because it has a lot of risk and the high valuation as well. So I hope you enjoyed this video, and please leave a like and subscribe to support this channel.